3 million pages of evidence, thousands of unsealed flight logs, millions of data points, names, themes, and timelines connected. You are listening to the Epstein Files, the world's first AI-native investigation into the case that traditional journalism simply could not handle.
Welcome back to the Epstein Files. Last time we looked at how corporate boards and advisory circles gave Epstein institutional legitimacy long after his conviction. Today, we are following the offshore banking network around Southern Trust, Swiss relationships, and cross-border money movement tied to Epstein entities. As always, every document and source we reference is available at epsteinfiles.fm. So start with the Southern Trust records and the related USVI filings, because they show how jurisdiction, banking structure, and compliance failures operated together in practice.
And this is where we really transition from the social network, the legitimacy he built, into the financial architecture.
The plumbing.
Exactly, the plumbing.
Yeah.
Because you're looking at a triad of systems that had to work together.
Yeah.
You have the tax shelter that the U.S. Virgin Islands provided. Then you have the layer of anonymity, which often came from Swiss banking structures and templates.
Right.
And then you need the liquidity. You need the access to the global financial system. And that was provided by major American financial institutions.
So this is a forensic audit. We're looking at how the money actually moved when the goal wasn't just to make more money, but to create opacity, to make it hard to follow.
That's the core function.
So let's start with the jurisdiction. The U.S. Virgin Islands. St. Thomas, specifically. This is the place he chooses to set up his primary operating entity after the Florida conviction.
A critical choice.
And the entity is called Southern Trust Company, Inc.
Southern Trust is.
Oh.
It's the keystone of the entire structure. If you pull it out, the whole USVI tax scheme falls apart.
So to understand Southern Trust, we have to look at the government body that enabled it, the Economic Development Commission, the EDC.
Right. This is the group in the USVI government that has the authority to grant these enormous tax breaks to companies that promise to set up shop and, theoretically create jobs.
I'm looking right now at the official transcript from the EDC's public hearing. The date is November 15th, 2012.
Okay, so let's set the scene. It's 2012.
Yes. Jeffrey Epstein is not some unknown figure. He is a convicted sex offender. He's been out of jail for a few years.
He's a registered level 3 sex offender in New York.
The highest risk category there. And a Tier 1 offender in the USVI itself.
So he is known to law enforcement, both federally and locally.
And he walks into this government hearing room to personally ask the USVI government for a massive tax break.
He's not just sending a lawyer. He's there himself.
He's there, but he's not alone. He's accompanied by his attorney, Erica Keller-Halls. And the pitch they're about to make it's just incredibly bold.
They're applying for benefits under a specific category, Category Thea.
As a designated service business. It sounds like a generic catch-all term.
It is, but you still have to define the service. You can't just get a 90% tax cut for, doing stuff. You have to articulate the value you're bringing.
And this is where it gets interesting. I want to read from the transcript how Attorney Keller-Halls describes what Southern Trust is going to do. She tells the commission, once it gets up and running, it will provide cutting-edge consulting services to companies around the world, relying in part upon the use of biomedical and financial informatics. Informatics.
Data mining. Algorithms. That's the picture they're painting.
A high-tech, sort of Silicon Valley-style operation based in the Caribbean.
They're claiming Southern Trust is going to be analyzing huge data sets, looking for cancer cures, DNA sequencing, global financial patterns, really sophisticated work.
And then Epstein himself speaks. This part of the transcript, I've read it so many times, and it's just baffling. He tries to explain this data mining concept to the board members.
He uses an analogy.
He does, about search engines. And you have to remember, this is 2012. It's not 1995.
Right. The internet is not a new concept.
Here's the direct quote. Jeffrey Epstein, supposedly this financial genius, explaining his high-tech business, he says, George Washington's horse. Okay, what would I have to do? I'd have to get on the bus and go to the library. Right now, we go to Goggle, and in a nanosecond, Goggle searches 10 billion documents.
Okay, stop right there.
Goggle.
He says Goggle, not Google. Goggle.
Like the things you wear to swim?
And he says it twice. We get a goggle.
This is 2012. Everyone knew what Google was. This man is claiming he runs a bleeding-edge informatics company.
Using complex algorithms to cure diseases.
And he can't pronounce the name of the most dominant tech company on the entire planet.
It's absurd on its face. But if you strip away the almost comedic aspect of it, think about the forensic implications.
Right.
You're a board member of the EDC. Your job, your fiduciary duty, is to vet the legitimacy of these businesses. And the applicant has just demonstrated a fundamental illiteracy in his own supposed industry.
It's a huge red flag.
It's more than a red flag. If someone comes into a bank for a loan to start an auto repair shop and they call a wrench a twist hammer, you don't give them the loan, you show them the door.
You kick them out. It's a competency question.
Exactly. It strongly suggests that the person speaking is not the person who would be doing the work, or more likely that the work itself doesn't actually exist.
And it doesn't stop there. He keeps going. He tries to pivot the conversation to medicine.
It gets even more incoherent, doesn't it?
It does. He tells the board, and I'm quoting again, "It turns out that many females for breast care, you can treat it with things that were only used before for prostate." And the only way they got to that is they realized that in certain studies in the Netherlands, just by these search engines, there had been good results.
It's a word salad. Females for breast care.
Things that were only used for prostate. What things?
It's completely nonsensical. It sounds like someone who read a headline of an article 5 years ago and is trying to bluff their way through a presentation.
But here's the crucial part. What the transcript shows, or rather what it doesn't show. I'm looking for the reaction from the board. Chairman Albert Bryan is there. Vice Chairman Nathan Simmons.
Do they challenge him?
Not at all.
Do they ask him to clarify any of this?
No.
Do they ask a single follow-up question? Mr. Epstein, what's your background in oncology? Or what specific software platform are you using for this data mining? Anything.
Silence. The transcript records zero pushback from the board. They just let him ramble on about Gogol and George Washington.
And then they approve the application.
Yes.
That's silence. That's the sound of regulatory capture. It implies that the decision was very likely already made before he even walked into the room. The hearing was just theater.
A formality.
They needed a transcript to put in a file cabinet so that later they could say, see, we followed the process.
Yeah.
But the process itself was hollowed out. It was a sham.
So let's look at what he actually won. Because
Right.
this wasn't some honorary certificate. This was about money. A lot of money. The USVI v. JP Morgan Chase complaint details the incentives he was granted.
And massive doesn't quite do it justice. It was a nearly complete tax holiday. But let's break down the actual numbers from the filings.
Okay.
A 90% exemption from income taxes.
So just to be clear for everyone, if Southern Trust reports $100 million in income, it only pays tax on $10 million of that.
Correct. And even on that remaining $10 million, the local corporate tax rate would be relatively low.
Yeah.
But that's just the start.
That's more.
A 100% exemption from gross receipts tax, 100% exemption from excise taxes, and the really crucial one, a 100% exemption from withholding taxes.
Okay, that last one, withholding taxes. Explain why that specific exemption is so important in this structure.
Because withholding tax is typically how government gets its piece when money leaves its jurisdiction.
Mm-hmm.
If a U.S. company pays a dividend to a foreign owner, for example, there's usually a 30% withholding for the IRS.
Right.
The USVI has a mirror tax code. With this exemption, Epstein could move money out of Southern Trust, pay it to himself as profit or dividends, and there would be zero exit tax. It's a completely fictionless way to extract cash.
So it effectively created a domestic tax haven.
That's exactly what it was.
A washing machine.
Yeah.
You put taxable income in one side from anywhere in the world, funnel it through this USVI entity.
And it comes out the other side, legally stamped tax exempt by a U.S. territory.
That's the brilliance of the scheme. He wasn't hiding cash in a suitcase. He was getting the government to officially bless it.
He laundered it through legislation.
But there's usually a catch with these EDC programs. The whole point is in the name, economic development.
Right. There's a social contract. You're supposed to hire people, build something, contribute to the local economy.
The statutory requirement almost always mandates a certain number of full-time employees, and specifically, you have to hire locals. That's the trade-off. We give you a huge tax break, you give our citizens jobs.
But an office full of local employees was the last thing Epstein wanted.
It would breach the secrecy. If you hire 10 Virgin Islanders to work at Southern Trust, eventually someone's going to raise their hand and ask, why is our server room empty?
Or why haven't we done any data mining today? Or ever?
And why does the boss keep asking for stacks of cash? So how did he get around that core requirement?
He used the informatics lie again. He weaponized the complexity he had invented.
I have the quote from the transcript. He argues that the work is just too specialized for the local workforce. He says, "It turns out that with 14 people in a room, everyone has a different learning skill. You just have to understand how to use this thing."
Again, it's complete gibberish. 14 people in a room. What does that even mean? But the underlying argument was simple. This work is so high-tech, so advanced, that we just can't find qualified people here in St. Thomas. Therefore, we need a waiver on the employment rule.
And his lawyer, Keller-Halls, formally requested that waiver.
And the EDC granted it. They bought the argument.
So he got to keep the main benefit, the tax immunity, while bypassing the main requirement, local job creation.
It's a masterstroke of regulatory manipulation. He created a company with no real physical footprint, no local employees, and a business model that was pure fiction, and yet it received the territory's most powerful economic incentive.
Okay, so that's the setup, the official story. Now let's pivot to the operational reality. We can fast forward a few years to when the USVI government itself sued JP Morgan Chase. And in that complaint, they lay out what their own forensic audit of Southern Trust actually found.
Right. They went looking for the work product. If you're a data mining company, there should be, well, data. There should be client contracts, reports, deliverables, invoices for services rendered.
And the complaint states very clearly, Southern Trust appeared to perform no informatics or data mining services.
None. Zero. It was a ghost ship. The entire premise presented to the EDC was a facade.
So if it wasn't doing data mining, what was it doing? When investigators looked at the bank accounts for Southern Trust, what did they see?
They saw a slush fund, a lifestyle fund. The complaint lists the outflows.
Not payments to data centers or software engineers?
No. Payments for private jet fuel. Payments to cover massive American Express bills. Payments for his properties. And, most chillingly, payments for what the complaint legally terms the instrumentalities of the trafficking operation.
Instrumentalities. That's a specific legal term.
It means the tools used to commit a crime. If you use a car in a bank robbery, the car is an instrumentality. Here, the money flowing out of Southern Trust was buying the plane tickets for victims, paying the recruiters, covering the expenses of the very locations where the abuse was taking place.
So the informatics company was just the wallet for the criminal enterprise.
It was the financial engine.
Pillar one, then, is the USVI providing the tax shelter. But now you have to move the money in and out of that shelter with a degree of anonymity. This is where the story goes across the Atlantic.
To Switzerland.
Specifically, we need to look at a document called the Deferred Prosecution Agreement Statement of Facts involving Bank Pictet and CSA.
This document is critical. It might not mention Epstein by name, but it gives us a perfect snapshot of the private banking risk culture during the relevant period, which is roughly 2008 to 2014.
This was the era when the U.S. Department of Justice was really going after Swiss bank secrecy.
It's exactly. The big cases against UBS, against Credit Suisse, the DOJ was aggressively hunting for undeclared accounts held by U.S. taxpayers.
And Pictet, which is a very old, very prestigious white-glove private bank in Geneva, was caught up in this. The DPA is basically their settlement to avoid prosecution.
And in it, the bank admits that it assisted U.S. taxpayers in maintaining what they call undeclared accounts.
Let's define undeclared. That doesn't just mean someone forgot to check a box on their tax form.
No, this is an active conspiracy to conceal. Under U.S. law, if you're a citizen and you have a foreign bank account with over $10,000, you have to file a form with the Treasury called an FBAR. Failing to file is a felony.
And Pictet was helping clients structure their accounts specifically to avoid that filing requirement.
Correct. And they used a very specific tool, which is mentioned in these documents.
Yeah.
The insurance wrapper, or PPLI, which stands for Private Placement Life Insurance.
It sounds so mundane, life insurance.
And that's the point. It's designed to sound boring so regulators don't look too closely. But you should think of it as a set of Russian nesting dolls.
Okay.
The biggest doll on the outside, the one the world sees, is a major insurance company. It could be Swiss Life, for instance, or another large carrier in a jurisdiction like Liechtenstein. The bank account at Pictet is opened in the name of that insurance company.
So if a regulator from the IRS requests the account holder information, they just see the name Swiss Life.
Exactly. And Swiss Life is a massive, legitimate, publicly traded company. No red flags go up.
But inside that doll.
Inside that insurance policy wrapper, you open the next doll, and that's where the client's assets are. Their stocks, their bonds, their cash. The U.S. client, the beneficial owner, still effectively controls the assets. They can direct the investment strategy.
But on paper, they don't own them.
Legally, they don't. the insurance company does. You've severed the chain of ownership. You've stripped the U.S. beneficial owner's name from the documentation that the bank would hold, like the Forms I.
It's a tool for layering, for creating distance.
The DPA states that Pictet maintained around 130 of these PPLI accounts for its U.S. clients. It's a classic tool to defeat KYC, Know Your Customer protocols.
And why go to all that trouble?
Because by 2008, Epstein is a known quantity. He's a felon, a registered sex offender. If he walks into a highly regulated bank and tries to open a standard account in his own name, the compliance software is supposed to catch that. It's a red dot, as we'll discuss.
But if the account is opened in the name of a giant Swiss insurance company,
It can slide right through. It provides liquidity with anonymity. It's a critical component for moving funds for illicit purposes without triggering immediate alerts.
So we have the USVI tax shelter, the Swiss anonymity wrapper. Now we need to follow the wires, the plumbing. For this, we have the JP Morgan Chase transaction logs and other EFTA documents.
This is the ground truth. You can listen to the pitches about informatics and cancer research, but the bank statements, they don't lie. The truth is in the pay line of the wire transfer.
I want to look at the outflows from the key Epstein entities. Plan D, Butterfly Trust, Financial Trust. These were his primary vehicles at JP Morgan. And the logs they're chaotic.
Chaotic is a very gentle way of putting it.
I'm seeing payments that have absolutely no connection to the stated business model.
Mm-hmm.
For example, here's a payment to Tibetan Mastiff Rescue for $15,000.
Right. A $15,000 donation to a dog rescue organization from a trust.
And then there are recurring payments to Victoria's Secret, payments to the New York Film Academy.
Okay, let's just pause on that one. Why is a fiduciary vehicle a trust, which is usually set up for things like estate planning or philanthropy, paying tuition fees for a film school?
And why is a company that supposedly mines biomedical data buying lingerie?
This is a textbook example of what forensic accountants call commingling of funds. In any legitimate business, there is a hard, bright line, a corporate veil between the company's money and the owner's personal money. If you own a restaurant, you don't pay your home mortgage directly from the cash register. That's a form of embezzlement.
But here, that veil is gone.
It never existed in the first place. The entity was the person. The moment you see a data mining trust paying for dog rescues in film school, the corporate structure is proven to be a sham. It has no independent purpose. It's just Epstein's personal checkbook with a fancy name.
The logs also show another much darker pattern. There are recurring structured payments to a list of individuals, many with Eastern European surnames.
And we have to be precise here, but the USVI complaint against JP Morgan flags these payments specifically. It notes that these women had no discernible business relationship with Epstein or his companies. They weren't informatics consultants. They weren't data scientists.
They were receiving regular payments, stipends.
Exactly. Structured payments, often for the same amount each month. And when you combine that data point with other payments in the logs, payments for recruitment fees, payments to modeling agencies, the Victoria's Secret expenses, the financial data begins to map almost perfectly onto the witness testimony of trafficking.
The bank's own transaction logs were effectively the payroll system for a criminal enterprise.
The evidence was flowing through their own systems.
Speaking of which, the logs also show enormous outflows to legal counsel. I want to read a few of these into the record because the timing is what's so significant. We're looking at wires from 2005 and 2006.
This is the absolute peak of the initial Florida investigation. This is when the Palm Beach police are closing in.
November 2005. There's a wire for $100,000 to Black, Srebnick, Cornspan, and Stumpf, PA, a major law firm.
Roy Black's firm, one of the most famous criminal defense attorneys in America.
Then later that same month, November 30th, 2005, another $100,000 to the same firm.
So that's $200,000 in 1 month.
April 2006, a wire for $100,000 to Gerald B. Leftcourt, PC.
Another titan of the New York criminal defense bar.
And then in August 2006, two payments, one for $150,000 and another for $200,000 to Alan M. Dershowitz.
So these documents are critical when we assess the bank's knowledge. A bank can often claim plausible deniability. We didn't know our client was in trouble. Or we knew there were rumors, but we didn't know the extent of it.
But they were processing the payments.
They were processing millions of dollars in payments to the country's top criminal defense lawyers who specialized in sex crimes. You cannot process the wire transfer, see the name Roy Black on the pay line in 2006, and then later claim you had no idea your client was under a serious criminal investigation for sexual offenses.
The bank wasn't just a passive holder of his funds. They were the logistical hub for his entire legal defense strategy.
They were funding the war room. The very law firms that negotiated the now infamous non-prosecution agreement were being paid via J.P. Morgan wires. The transaction logs read like a real-time chronology of the legal battle. Every time the pressure ramped up in Florida, a new set of wires went out from New York.
Let's also talk about physical cash, because in this digital financial world, large amounts of cash are a huge anomaly.
A massive anomaly.
The USVI complaint alleges that over just a 4-year period, there were more than $800,000 in cash withdrawals from his accounts.
$800,000. Let's just pause to consider the physicality of that amount.
Oh.
Have you ever tried to withdraw, say, $10,000 in cash from your bank?
It's an ordeal. Alarms go off, you have to fill out forms, the branch manager has to approve it.
Right. It automatically triggers a CTR, a currency transaction report, to the Treasury Department. Now imagine doing that repeatedly to the tune of $800,000. This is not walking up to an ATM. This is prearranged. This is bags. This is suitcases of cash.
And the question is why? Why does a billionaire need that much physical cash?
Because cash is the only truly anonymous way to pay someone. If you send a wire, there's a record. If you write a check, there's a record. If you hand someone an envelope full of $100 bills, that transaction, from a data perspective, essentially never happened.
It's the currency of off-the-books activity.
It's the currency of crime. In the world of legitimate high-net-worth finance, nobody uses cash for major expenses. You don't buy art with cash. Don't pay for jet fuel with cash. You use traceable wires for audit purposes.
So these large cash withdrawals are a BSA red flag.
They are the quintessential red flag under the Bank Secrecy Act. Large, repetitive cash withdrawals with no clear business purpose are the #1 indicator of potential money laundering or illicit payment schemes. It's AML 101. It's a flashing neon sign that says, investigate this account.
And the documents show the bank notice. There is an internal J.P. Morgan email from July of 2013, cited in the complaint. It's from a compliance officer named Ryan to a colleague named DeLuca.
And what does it say?
Ryan writes, very simply, issue is he really never stopped the large cash withdrawals.
He really never stopped.
Okay.
Just listen to the weary resignation in that phrase. It implies this wasn't the first time it came up. It implies they'd had conversations. They'd likely asked him to stop. Mr. Epstein, these large cash withdrawals are creating a compliance issue for us. And his response was essentially to ignore them.
And the bank's response was to keep banking him.
And that is the absolute core of the failure. In a functioning compliance system, if a high-risk client repeatedly engages in red flag activity and refuses to stop when asked, you exit the client. You de-risk. You file a suspicious activity report, and you close the accounts.
You don't just send a memo to your colleague complaining about it.
You don't just shrug and go back to work. But that's what happened here.
Which brings us directly to the internal compliance controls at J.P. Morgan. We've mentioned the term red dot before. I want to unpack what that actually means. The USVI filing references internal JPM discovery documents about their red dot system.
Red dot is J.P. Morgan's internal name for derogatory information that's been identified by their Global Security Services team.
And Global Security Services, this isn't just a couple of security guards.
No, this is the bank's own corporate intelligence agency. They hire former senior people from the CIA, the FBI, MI6. Their entire job is to conduct enhanced due diligence on high-risk clients and to know who the bad actors are.
And if they find something negative news, criminal charges, sanctions links, reputational risk, they flag the client's file with a red dot.
It's a digital scarlet letter inside the bank system.
Epstein had a red dot.
He had a whole constellation of them.
The documents show that a rapid response team meeting was convened specifically about him on October 17, 2006.
Okay, the timing there is key. October 2006. The Florida investigation is at a boiling point.
So take us inside that room. What is a rapid response team meeting? What happens there?
A rapid response meeting is a formal escalation. It means the background risk has become an acute present danger to the bank. And you typically have two opposing forces at the table. On one side of the table, you have the control functions. Compliance, legal, global security. Their job is to protect the firm from regulatory fines and, in a worst-case scenario, criminal charges.
Yeah.
They're looking at the red dot, the indictment, the sex offender registry, and they are saying, this client is radioactive. The risk is unacceptable. We have to exit him.
And on the other side of the table?
You have the business side, the private bank, the relationship managers. Their job is to generate revenue. Their bonuses are tied to the assets they manage. They're looking at the exact same client file, but they don't see risk. They see tens or hundreds of millions of dollars in assets. They see fees. They see his network of other ultra-wealthy potential clients.
And they're arguing to keep him.
They're arguing, we can manage this risk. We can put enhanced monitoring in place. We can contain it. Don't fire our profitable client. It is a fundamental conflict of interest that exists inside every major bank.
It's a battle between the bank's safety and the bank's profits.
Precisely. And the meeting minutes from October 2006 tell us exactly who won that battle. The decision was not to exit the client. The decision was to monitor the account.
So the business side won.
The revenue generators won. They looked squarely at the documented risk, at the indictment for sex crimes with a minor, and they made a conscious business decision to retain the client and keep the money. That single decision in 2006 is the pivot point. If they had followed their own protocols and exited him then, the vast majority of the financial infrastructure we're discussing, the Southern Trust accounts, the millions in cash withdrawals, it wouldn't have happened to J.P. Morgan.
The complaint filed by the USVI also cites a J.P. Morgan training document. The title is What is Human Trafficking? The irony is it's just staggering.
It is, but it's also standard procedure. Every big bank has these mandatory annual trainings. You click through a slide deck, you learn the red flags, you take a quiz at the end to prove you did it.
And this training document, according to the complaint, listed very specific transactional indicators of human trafficking. I'm reading the list now. Structured transactions, payments to online escort services, and unexplained payments to women.
Okay, now hold that training manual in one hand, and in the other hand, hold the EFTA transaction logs for Epstein's accounts that we just discussed.
And compare the two.
It's a direct match. The recurring, unexplained payments to women with Eastern European surnames, that's on the list. Check.
Structured transactions, like the cash withdrawals just under the reporting threshold. Check.
The payments to modeling agencies and for lingerie, it all fits the pattern. So the evidence shows two things very clearly. One, J.P. Morgan possessed the institutional knowledge and training to spot the crime. They literally wrote the manual on what to look for.
And two,
they possessed the client's own transactional data that perfectly matched the patterns described in their own training manual.
so this wasn't a failure of detection. The system worked, the alarms went off.
No, the system worked exactly as designed. The red dots appeared. The transaction monitoring likely flagged the payments. The failure was a failure of action. It was a human decision to see the pattern, recognize it for what it was, and then override the system and do nothing. That is a conscious choice, not an accidental miss.
This leads to the issue of SARs, suspicious activity reports, the formal legal obligation. The USVI v. J.P. Morgan opinion and order written by Judge Rakoff goes into this.
The SAR is the legal mechanism for a bank to report potential crimes to the government. Under the Bank Secrecy Act, if a bank employee detects activity they suspect could be related to money laundering or other crimes, the bank is legally required to file a SAR with FinCEN, the Financial Crimes Enforcement Network.
And there's a deadline?
Strict deadline. 30 days from the date of detection. Not 30 months, 30 days.
The complaint alleges that J.P. Morgan delayed filing SARs for, quote, thousands of transactions totaling more than $1 billion.
$1 billion in transaction volume. And the allegation is that these SARs weren't just a little late. They were filed years after the fact. In many cases, only after Epstein's death in 2019, when the scandal was on the front page of every newspaper in the world.
A SAR filed 10 or 15 years late. What's the point? It has no investigative value at that point.
It has no value to law enforcement. But it has immense value to the bank's legal team. It's a practice known as defensive filing. When the crisis finally hits, the bank's lawyers will instruct the compliance team to go back and file reports on everything they should have reported a decade ago.
Why?
So that when the regulators in Congress come knocking, the bank can hold up a stack of paper and say, look at all the SARs we filed. We were compliant. We reported this. It's an attempt to create a retroactive paper trail of compliance.
It's covering your tracks.
It's pure damage control. The safe harbor provision in the law, which protects banks from liability when they report suspected crimes, is predicated on timely reporting. You cannot knowingly facilitate suspicious activity for a decade, collect hundreds of thousands of dollars in fees, and then file a report only after the client is dead. That's a violation of the entire spirit and letter of the Bank Secrecy Act. It suggests the client relationship was prioritized over the regulatory duty.
I want to zoom out for a moment. We've talked about the bank's failures, the USVI government's failures, but how did he do it? How did he get these powerful institutions to consistently look the other way?
But understand that you have to understand the concept of the high-value client defense. The USVI complaint has a whole section on this, titled Epstein Brought Additional High Net Worth Clients.
This is the why. This is the motive.
This is the leverage he had. In the world of private banking, the key metric for success is net new money. How many new assets did you bring into the bank this quarter? Epstein wasn't just a client with his own couple $100 million. He was a hub, a node in a network of immense wealth.
The complaint specifically alleges that Epstein provided referrals of high-value opportunities and clients to senior J.P. Morgan executives, including Jess Staley.
He was a gateway. He knew billionaires, politicians, royalty, Nobel laureates. For a private banker, Epstein was the golden goose. Not just for the fees on his own accounts, but for the introductions he could provide.
So if you're the relationship manager and you decide to fire Epstein for compliance reasons,
You don't just lose his money. You risk losing access to his entire network. You risk offending the other powerful people he might introduce you to. It's a career-limiting move.
so there's fear involved, fear of losing future business.
Fear and greed. That internal battle we talked about between remediation and exit, it was a constant struggle. They were weighing the tangible, immediate revenue from the relationship against the more abstract future possibility of compliance risk. And for more than a decade, the revenue won that fight every single time.
And what about on the government side? In the USVI?
It's the same dynamic, just a different currency. Call it regulatory capture. The Virgin Islands at the time was desperate for what it saw as sophisticated economic activity. They wanted to diversify away from just tourism. They wanted to be a player in global finance.
You wanted the informatics story to be true.
They wanted it to be true so badly that they were willing to ignore all the signs that it wasn't. They ignored the fact that the CEO of this supposed high-tech firm couldn't pronounce Google.
They compartmentalized. They siloed the information.
Exactly. They put Jeffrey Epstein, registered sex offender, in one box, and they put Jeffrey Epstein, brilliant informatics entrepreneur, bringing jobs to the island, in another box. And they just pretended those two boxes had no connection to each other.
They used a legal argument, didn't they? The nexus argument.
They did. The EDC in the governor's office argued that his Florida conviction had no nexus, no connection to the operation of his businesses in the USVI.
That feels like an incredibly thin wall to build.
It's a paper wall. But it was just enough legal cover for them to sign the tax certificate. The complaint even quotes testimony where the act of the governor, John Shaw Yong, signing off on the tax benefits was described as little more than a formality.
A formality to give a 90% tax break to a Tier 1 registered sex offender to run a phantom company?
And that's the banality of how these things happen. It's not always a grand conspiracy in a dark room. It's often just a series of bureaucrats stamping forms because it's easier than asking hard questions, or bankers ignoring alerts because their bonus is on the line.
So let's bring it all together. Let's summarize what these documents, the Southern Trust filings, the Swiss DPA, the JP Morgan logs, what they actually prove. If you strip away all the noise, what are the hard forensic conclusions?
The documents prove a specific architecture. This is not a theory. We have the blueprints, and it stands on 3 pillars.
Pillar 1, fact number 1. Southern Trust fundamentally misrepresented its business activities to the government of the U.S. Virgin Islands.
Absolutely proven. The informatics and data mining claims were a complete fabrication, a cover story told for the sole purpose of securing tax immunity.
Pillar 2, fact number 2. J.P. Morgan facilitated nearly $1 million in cash withdrawals and millions more in suspicious payments to lawyers and young women, despite having numerous internal red dot alerts on the client for years.
That's all documented in their own transaction logs and internal emails. They provided the liquidity. They kept the machine running.
And Pillar 3, fact number 3, the informatics company, Southern Trust, was nothing more than a shell entity used to pay for the personal lifestyle, the criminal enterprise, and the legal defense of its beneficial owner, Jeffrey Epstein.
The commingling of funds proves that beyond any doubt. The payments to Victoria's Secret and top criminal defense lawyers from a corporate trust account demonstrates the entity had no legitimate, independent existence. It was an alter ego.
So what's the final synthesis? What does this all add up to?
It adds up to the fact that this was not a passive banking relationship. We often hear the defense from banks that they were simply deceived by a sophisticated criminal client. The documents do not support that narrative.
This was active management.
It was an active, knowing management of high-risk capital. The institutional controls, the red dots, the trafficking training at the bank, the employment requirements in the USVI. All of these controls existed. They were on the books. They were specifically designed to prevent exactly this kind of abuse, but they were systematically and manually overridden by senior decision makers in both the private and public sectors.
So the system didn't fail. It was deliberately bypassed.
It was turned off. The USVI provided the tax-free wrapper. The Swiss banking model provided the templates for anonymity. And the U.S. bank provided the access to cash and the global financial system. It required all three to function. If any one of those pillars had held firm, if the EDC had demanded proof of the data mining, if a Swiss bank had refused the anonymous structure, if JP Morgan had acted on its own red dots in 2006, the entire architecture would have collapsed. It only stood because every institution involved made a decision to look the other way.
Next time, the art world's dark secret, Epstein's collection.
You have just heard an analysis of the official record. Every claim, name and date mentioned in this episode is backed by primary source documents. You can view the original files for yourself at epsteinfiles.fm. If you value this data-first approach to journalism, please leave a 5-star review wherever you're listening right now. It helps keep this investigation visible. We'll see you in the next file.